Hello, hello. So Starbucks just reported a few minutes ago, and I wanted to make a video about it because I think it's very interesting, and it's a company that I would definitely look to add in a portfolio if I already didn't own it myself, actually. Now, Starbucks stock jumps as coffee chains traffic grows for the first time in 2 years. So they haven't been doing great in the past few years, and I have seen it also in the returns of this company basically being relatively stale. And they missed fiscal first quarter earnings estimates, but said transactions grew for the first time in 2 years, even though their prices have been skyrocketing in terms of their coffees, which were already expensive to begin with. Now, the same store sales, this means the stores that already existed in the previous year, basically not new ones, climbed as CEO Brian Nichols' turnaround plan takes hold, and they are expected to share short-term financial targets at an investor day. Now, Starbucks is very important in terms of consumption in the US. Having lived in the US myself, it's almost like a habit that people have. For many people, it's like a daily routine, including myself, actually, when I was working in the US because I'm a coffee lover. Starbucks is practically speaking the only real option that you find everywhere, apart from the chains. Some chains that are like smaller, like Blue Bottle, for example, but they are mostly sort of like in the San Francisco area, like the metropolitan area. It's not easy to find them all around. They're more niche. Now, this is one of the core reasons because I like, even though I'm not a huge fan of retailers, I like this kind of mode where it's practically impossible to replicate because Starbucks, even though it can go up and down quite a lot, it's gonna be a tough company to ever bankrupt. Not that it's impossible, of course, anybody can, but it's gonna be hard. And if you are looking to get like more stable companies, it almost has this kind of McDonald's type mode, pretty much. Now, Q1 results demonstrate the back to Starbucks strategy. That's pretty important, going back to their old stuff. And they shared that the financial outlook, since suspending its forecast in October 2024, obviously not doing great, I suppose, back then. Starbucks is projecting adjusted earnings per share in the range of 215 to 240, on the lower end of Wall Street estimates of 235. Okay. And the company is also projecting global and US same store sales growth of at least 3%. And it says it's 8%. I think I saw something like 5 to 6 right now. But the earnings per share still a little bit lower than expected, but revenue higher than expected here, showcasing the fact that their net income has been going down because of expenses, which we will see also later in the tool. But the Coffee Giant reported fiscal first quarter net income attributable to shareholders pretty much of 293 million or 26 cents per share, but down from 780 million of or 69 cents per share. In addition to costs related to the turnaround, higher coffee prices and tariffs weighed on the company's margins, understandably so. And you will see it again in the tool a little bit later, why their margins have suffered and everything like that. Net sales rose 6%. This is pretty important. Revenue going up. Top line, that is. Revenue is the top line, basically the amount of money that you bring in. And signaling a turnaround, signaling that the customers still enjoy getting Starbucks, and this is where all the good things begin. Pretty much having a top line that grows higher. You have to make sales in order to make net income, right? And the global same store sales 4% up, topping the estimates that they did have. And so, yeah, generally speaking, it looks like the company is delivering much better results than the previous 2 years. And they are also opening 128 net new locations during the quarter. So pretty nice, pretty neat. Now, if we take a look at the doings of Starbucks, you will see in the past like 3 years that it hasn't been great for them. They are almost stale, if not down a little bit. And I think when I bought it, it was like something like 80 or so. Been a while since I checked it, but it hasn't been doing a ton actually, and it's concerning, of course. It's nice to see that they are starting to actually do a little bit better right now. Now, the P ratio of the company is still high, even though the price has been down. That's because their net income has been going down. They have had a lot of expenses in the past, with their net income going down quite significantly. Yet still, their outstanding shares go down as well. So they still buy back their shares, and this is why some of these values here are suppressed. especially the margins, especially the net income margin, for example, or the operating margins, similarly, or as expected, going down at a similar pace, very understandable. And the returns here also suffering a little bit, as you can understand, with the debt to equity being negative because they have negative numbers here, is what you say. Very interesting things from the company, but they kind of signal an interesting workaround and turnaround as well, potentially signaling that it could be a good buy right now. Now, if you take a look at the revenue of the company, you'd see it increasing ever so slightly here, sure, but still increasing. And if you look at the operating income of the company over here, you will see that it is increasing as well. So it's not like the company has operating troubles in terms of their equity pretty much going down. It's mostly about the fact that they are accumulating debt, for example, and not being able to make that much money. It's not that they have troubles with actually selling stuff, which is important and more reassuring. And you can kind of see it here in the balance sheet of the company that their liabilities have grown massively. And this is what's causing the issue for them, the total liabilities. Take a look at the line here, back in 2016, and take a look at it now, the latest quarter. Huge increase over here, absolutely tremendous increase. And this is why this is happening for the company right now. Okay, but if we take a look at the stock analysis here, and we could even take a look at the stock analysis, but don't want to make the video too long for this one. But quickly taking a look at what has been going on in the previous quarter, that is the previous quarter for Starbucks, and since this is Q1 2026, which will be coming in to the tool very shortly when it's released in SEC, this is FY 2025, pretty much the previous period. And of course, you can find all these in StockAE Insights, by the way, .com. There's a free account also. I'd love you to join and tell me what you look of the two, what you think about the two. But yeah, you can see all the things here that have been going on with the company here, and the issues that they have, the fact that they had debt, for instance, which is pretty important. What the thing says here, that Starbucks is undergoing a painful $1 billion identity crisis, slashing its store footprint and selling off control of China to stabilize margins is what has been going on. But then, at least in the next quarter, we're going to be getting a little bit of a better outlook, because previously you'd see things like, like closing stores, but they did have cash. They owe a lot more, yes. They have a ton of debt, big plans in China, bills and stuff. We kind of know about what is going on with the company, but it could be an interesting opportunity. Now, the last thing that I want to check is always I like to see the stock evaluator, because it gives me an idea of the cash flows of the company. Usually in this kind of market, things are going to be expensive, and I would expect that even from a suppressed company. And you'll see the company that even doesn't do great in net income growth and everything. Hence, I still use my StockAE Insights Lucky 13 with a 13% required return here, and a revenue growth that approaches the average that the company has been doing, about 9.6%, and net margins 10%. The fiscal year margins about 10% too. So this is working around these numbers. So typically these two tend to be closer to reality, and this one is more conservative. If I calculate the values right now, I'm gonna see something like probably about $50, I'd say, is about the fair value for the cash flows, pretty much, if we consider this like company producing cash flows, which we should, because that's what we're investing in. But there are other things to take into account, and growth potential, a moat, and all that, generally speaking, increase the value of a stock. Like 95 right now is still expensive, but not outrageously expensive is what I'd say. Something around maybe 50 to 60 would be a very fair deal to buy if this ever happens. I don't think it will go down that much, but even if we see something like 70 for purchasing and holding through the years, I think this would be a nice stock. And you may be seeing 95 now and 100, but it doesn't take long before we have like the next mini crash that lasts for a year or so, and this you suddenly see this at 70. So bear this in mind, and this is why you need to see all these earnings reports as they come in, and understand and evaluate how the company is doing, because now we're seeing a glimpse of hope here for a return from Starbucks. And if this still has like negative territory assessments from a lot of people, and it's getting treatment like it's a it's not doing that great, it may become a good opportunity through the next 1 or 2 years, is the thing, or even less, frankly. So bear this in mind. Thank you for watching. I'll see you in the next video. Remember to like the video and subscribe if you are not a subscriber already. I will see you in the next one. More earnings coming up soon next. Thanks.